Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down my top 3 dividend stocks for Canadians. I picked these 3 stocks because they all pay a generous dividend, they all have a long history of increasing their dividends, and they all come from different industries, giving you a fairly diversified portfolio of the Canadian market. I have a long list of dividend and growth stocks, as well as ETFs and bonds that I personally love. But I think that these 3 stocks would be a great starting point for any Canadian investor, especially for beginners in their 20s. These are stocks that you should buy and hold for the long run. Unless something catastrophic happens, I'm planning on holding on to these stocks for life and earning that passive income by collecting a sweet dividend every 3 months. For the Canadians watching, I recommend holding on to these stocks inside your TFSA or your RRSP if you have the contribution room. This way, you won't be paying any taxes on your dividends or on your capital gains when you decide to sell. I'll dive deeper into TFSA and RRSP strategies in a later video, but for now, I'd recommend that you buy these stocks in your TFSA first, then in your RRSP, and finally in your taxable accounts. So without further ado, my top 3 Canadian dividend stocks are Enbridge, RioCan, and TD Toronto Dominion Bank. If you haven't been watching my investment series, check out my last video where I broke down the importance of investing in the long run and the fundamentals of dividend stocks. Click the pop-up at the top right to watch that video first. So with that, let's jump into our first stock, Enbridge. Enbridge is one of the largest energy and utility companies in North America, and they're the 3rd largest overall company in Canada. Their core business units are oil pipelines, natural gas infrastructure, and utilities and power distribution. They are also involved in renewable energy, mainly wind generators. A good dividend stock is a company which is profitable in every season, no matter what is happening to the global stock market, and utility companies are a perfect example. Whether there is a stock market boom or a recession, people need their electricity and their gas. So utility companies like Enbridge can afford to pay consistent and generous dividends year after year. Out of all the stocks I own, Enbridge pays the highest dividend yield at a whopping 6.2%. In my last video, I warned that any company that pays a dividend larger than 6% is a warning sign, but Enbridge doesn't have any of these red flags. Their dividend payout ratio is 80%, which is right around the industry average for utility companies. That means that 80% of Enbridge's profits go out to investors in the form of dividends, leaving 20% of Enbridge's profits to invest in themselves as a company. This is a good position to be in. A lot of the companies with dividends larger than 6% have huge payout ratios, usually above 150 or 200%. In those cases, those companies are paying more than double their profits out in dividends, which is not sustainable. But with a payout ratio of 80%, Enbridge is not in that position. The dividend yield of 6.2% is already incredible, but it gets even better. Enbridge has increased its dividend for 22 years in a row, increasing by about 10% every year. This is exactly what we look for in a long-term dividend stock. Another reason why I love Enbridge is that it has a huge dividend and a fairly low stock price at around $46 per share. Because of that, you only need to own $3,000 of Enbridge stock to qualify for a DRIP. A DRIP stands for Dividend Reinvestment Plan. And that means instead of receiving your dividend in cash, your dividend is used to automatically buy more shares of the company without paying any commission at all. This is the best way to reinvest your profits and compound your investment, giving you true exponential growth. In the case of Enbridge, if we invested $3,000 in Enbridge stock, the 6.2% dividend would give us $186 a year or $46.50 every quarter. A single share of Enbridge costs $46, so every 3 months we can afford to buy a new share using just our dividend. If we enroll in a DRIP, instead of getting that $46.50 dividend in cash, we will automatically buy an extra share of Enbridge for free, and the remaining 50 cents will be paid out to us in cash. In this way, we get a free Enbridge stock every single quarter for every $3,000 we have invested. Without a DRIP, we can still manually spend that $46.50 to buy an extra Enbridge stock, but it will cost us between $5 and $10 in commission fees depending on your broker. Using a DRIP, we don't pay any commission at all. I'll make a whole video just about DRIPs in the next few weeks. I'll explain how I calculated this $3,000 amount and the different strategies I use to maximize my DRIP benefits. Looking at the stock chart of Enbridge over the past year, you can see that there have definitely been a lot of ups and downs, but that's okay. Even if the stock remained flat, I would still hold on to it and collect that 6.2% of passive income year after year. In fact, whenever the stock does dip, I buy more of it. Enbridge is the third largest company in Canada, and I know that they're not going anywhere. Whenever the stock drops in value, some people panic and start selling, but that's when I jump in and buy even more stocks at a discounted price. I know that the stock will bounce back up in a month or two, and in the meantime, I'm still collecting that 6.2% passive income. My second favorite Canadian dividend stock is RioCan. RioCan is one of the largest REITs in Canada. A REIT is a real estate investment trust. It's a large company that owns hundreds or thousands of properties and rents them out for a profit. REITs are basically a way to invest in real estate through the stock market. Most young Canadians cannot afford a down payment in the big cities like Toronto or Vancouver, but you can still tap into the real estate market by owning stocks in a REIT like RioCan. The best thing about REITs is that they're required by law to pay out a majority of the profits to investors through dividends. Essentially, this means that a REIT will never cut its dividends without facing legal and financial consequences. RioCan is one of the largest REITs in Canada, focusing mostly on commercial real estate. RioCan owns hundreds of shopping malls and shopping plazas all across Canada, but they also own significant residential property. RioCan pays a great dividend of 5.4%, but the best part is RioCan pays out its dividends every month, not just every quarter. This means that you will get 12 dividends a year, whereas most stocks only pay you 4. This makes sense because RioCan makes its profits through rent, and rent is usually collected once every month. So as an investor, RioCan pays you a portion of that rent every single month. Another great thing about RioCan is that they have a pretty low dividend payout ratio of only 60%. This means that 60% of their income goes out to dividends, leaving them 40% of their income to buy more property, thus increasing the value of the company and increasing the value of your stock. A lot of REITs in Canada have payout ratios over 80 or 90%, so they don't have a lot of spending money to buy more property and grow the way that RioCan does. Since RioCan has this extra spending money, they've been increasing their dividends every year or every 2 years, which is exactly what you want out of a dividend stock. Since RioCan pays out its dividends every month, each dividend will be smaller than the dividend you get with Enbridge, but you get them more frequently. To qualify for a DRIP with RioCan, you need to own about $5,900 in stocks. With a 5.4% dividend, that will get you $318 a year or $26.50 a month. That's enough to buy yourself a free stock each and every month while avoiding commission fees. So if you have $5,900 invested in RioCan, you will receive a free stock every single month. That's 12 free shares a year. Looking at the stock chart of RioCan over the past year, you can see some fluctuations, but generally it shows an upward trend. It's not a huge growth in value, but I don't really need this stock to grow much. I'm happy with holding onto the stock and collecting that 5.4% passive income every single month. And finally, my third favorite dividend stock for Canadians is TD, Toronto Dominion Bank. I could have picked any of the 5 major Canadian banks: RBC, BMO, Scotiabank, CIBC, or TD. Honestly, all 5 of them are solid dividend stocks, and I personally own all of them, but I would say that TD is my favorite. These banks are some of the best dividend stocks out there. That's because in Canada, the banks are heavily regulated, far more so than they are in the US. Canadian banks aren't allowed to deal in risky speculation, and so they're able to provide far safer and more consistent profits than in America. For example, in the 2008 financial crisis, all of the US banks took a major blow, requiring buyouts from the government just to stay afloat, whereas the Canadian banks were minimally affected. That security and reliability are why the Canadian banks are some of the best dividend investments out there. TD is the second largest company in Canada, just behind RBC Bank. But the reason why I choose TD over the other big Canadian banks is because TD has invested a lot of money to expand into the US, and they have been extremely successful. In fact, TD now has more branches in America than they do in Canada. And because of that, I think that TD stock will grow faster than all of the other Canadian banks, all while providing a generous dividend along the way. TD currently pays out a healthy dividend of 4% paid out every quarter. On top of this, TD has an extremely low dividend payout ratio of only 44%. That means that TD only pays 44% of its profits to dividends, leaving them 56% of the profits to invest in themselves and expand. Also, since TD is able to save so much of its net income every single quarter, They have never missed a dividend payment in 162 years. Even better, TD increases its dividends almost every single year. TD's price per share is significantly higher than RioCan and Enbridge at $74. Because of this, it will take a larger investment to qualify for a DRIP. You'll need to have at least $7,400 in TD stocks. With a 4% dividend, this will give you $296 a year or $74 a quarter, just enough to buy yourself a free stock in TD. Looking at the stock chart of TD over the past year, you can definitely see some ups and downs, but a general upward trend. Looking at the past 5 years, however, you can see a much clearer upward trajectory. I would call TD a dividend growth stock, giving you the best of both worlds. If this upward trajectory continues, in about 20 or 30 years, I can sell this stock and make a considerable profit in capital gains. On top of that, I'll be earning myself 4% in passive income every quarter along the way. So there you have it. Those are my top 3 best dividend stocks for Canadians. Enbridge gives you the largest dividend, RioCan pays you dividends every single month, and TD gives you the best growth and capital gains. But all 3 of these stocks will give you consistent and increasing dividends year after year, while giving you decent exposure to 3 different industries. So buy these stocks and hold on to them for life to collect that passive income, especially if you put them in your TFSA or your RRSP accounts. Another important thing to note is that TD and Enbridge are sold on both the Toronto Stock Exchange and the New York Stock Exchange. Make sure that you buy these stocks in the Toronto Stock Exchange, the TSX. If you buy them through New York, you'll be buying them in US dollars, and so you'll be losing money in currency conversion fees, plus you'll have to pay US withholding taxes on these dividends. But if you buy them through the Toronto Stock Exchange, you'll be buying them in Canadian dollars, and if you keep these stocks in your TFSA or your RRSP, you will never pay any taxes on these profits. I'll show you what I mean on Questrade, which is my favorite online broker. If I just search TD, the first one that pops up is TD through the New York Stock Exchange. We do not want this. Instead, search td.to to specify the Toronto Stock Exchange, and you'll see that TSX shows up in brackets, and that's what we want. I'll show you a step-by-step walkthrough of how to buy stocks and ETFs through Questrade in an upcoming video, and I'll compare Questrade to other online brokers. I like Questrade the best because they only charge you $5 commission when you buy stocks, and they charge you 0 commission when you buy ETFs. I'll save a detailed breakdown of Questrade in a later video, but if you want to get started with buying these 3 stocks in Questrade, click my referral link in the box below to set up a new account, and you'll get $50 of commission-free trades, and I'll get a small referral bonus too. I hope this video helps you get started with dividend investing in Canada, and please let me know if you have any questions. I'll be releasing more stock pick recommendation videos like my favorite US dividend stocks, my favorite bonds, and my favorite ETFs, so check those videos out soon. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. I'll be releasing a new video every single Thursday. And let me know in the comments down below, what are some of your favorite Canadian dividend stocks? Be sure to tune into my next video where I'll be returning to my investment series, and I'll be breaking down the difference between stocks and bonds, as well as the importance of asset allocation. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.